Let's go on to our Wrap the Week segment. This is where we focus on how the picture has evolved over the last 7 days, over the last 5 trading days or 4 trading days with the shortened holiday week. I want to start with a poll, though. We asked you recently, which of these would you rather own over the next 3 months? Consumer discretionary, consumer staples, or cash? I'm struck when I look at the results, to be honest with you, how evenly matched they all are. Consumer discretionary narrowly edging out the other two with 40% respondents. 34% of you said you'd rather be in cash than either of the two consumer sectors, and 26% of you said XLP, consumer staples. It's an interesting question because I tend to think of it as a binary outcome, thinking of, do I want to be in the strength of consumer discretionary or the weakness? And a better way to say that is the offense of consumer discretionary or the defense of consumer staples. But remember, there's that third option, which is neither, right? Going into cash. And it's interesting to me that a third of you said that cash would be the right answer. You'd rather be in no stocks between those two, but rather in cash. It'd be interesting to see, because that ratio, as we'll see here in a minute when we get to our the Mindful Investor Live Chartless, that ratio is actually potentially breaking to new swing lows. Hasn't really made a new low since the February 2020 into March 2020 market high. That's the last time the ratio has broken down to the point where it's almost breaking down today. So we'll look at that here in a little bit. Let's continue on with our Wrap the Week segment. We'll start just looking at the S&P and some other major asset classes today. We're going to look at the weekly changes in all of those asset classes. Then we'll get to our Mindful Investor Live Chartless to hit on the key themes from the week. So today was certainly about market strength. The S&P closing around 4230, up 0.9% from where we were on Thursday. The last couple of days have been more distributive. Today was anything but. Today was all about risk on, all about stocks going higher. And not to jump too far to the conclusion here, but we're at a new closing high. I don't think we quite made it. We're really, really close to the high from early May, but we're certainly right knocking on the door. And so I think the key with the S&P is we are testing the upper end of this range. My question would be, do we have enough momentum going into next week, enough demand or enough buying power to push the S&P further to new highs? It's worth noting, by the way, that the S&P is testing a new all-time high, while the momentum is much lower than it was last time we were here. Every time the S&P has pushed higher in the last 2 months, the momentum has been lessening and lessening. Now, what you may answer is, isn't that what happened back here in January, February? And absolutely. I remember talking about this chart a great deal, talking about the warning signs of the market moving higher on lower momentum. That was invalidated by the way we finally made new highs and the momentum broke out. And that breakout in late March is what really, I think, changed any minds. If you were bearish, I think you had to acknowledge that we had gone on to new highs. We're in a similar sort of pattern that we were sort of back here, sort of in mid-March. And so the question is, do we resolve like we did that time, which was a brief pullback to the 50-day before a rotation higher, or have we exhausted the uptrend? Only the chart itself is going to tell us which answer is correct. Very quickly, mid caps and small caps lagging. So this is very much the mega cap sort of FAANG stocks that were pushing higher. The VIX is back below 17, almost to 1650, and the NASDAQ 100 outperformed pretty much everything else. Bonds are back in an uptrend, at least on the tactical time frame. We're going to look at a chart of the TLT here in a little bit, but testing that 140 level, which has been resistance for quite a while. 10-year yields back lower, below 160 for the first time in quite a while. Gold and silver, though, working just fine. So if you think of gold and silver, or especially gold, as sort of the safe haven, a risk-off play to get away from stocks, that's not the case. I'd say we are seeing a risk-off moves with cryptocurrencies, which continue to deteriorate. We've talked about the weakness in Bitcoin. We looked at that chart of Bitcoin. I still think we're going to see lower prices than we're at right now, right around 37,000. And I think checking the Fibonacci retracements on the chart of Bitcoin could serve you pretty well. Very quickly, just today, as a reminder, tech, communication services, consumer discretionary, the top 3 sectors, far outpacing pretty much everything else. The cyclical leadership we've been talking about was really sort of mid-range relative to the S&P underperforming a little bit. And then on the downside are really the defensive plays like utilities and real estate, certainly underperforming during the course of the day today. Let's look at how the week evolved. We'll update this chart. If you follow along with my voice and the cursor, you'll see what is what, but the S&P 500 is right here in black. I have to update this chart. I'm just realizing it because we're taking in just a little too much data here. Let's do 4 days because we had the holiday. and we'll take it from last Friday. We skip Monday, and here we go. All right, so looking at the 4-day returns here since last Friday, we have the S&P up 0.6% really. What underperformed the S&P this week? The NASDAQ 100 up 0.5%. The US dollar is actually flat, up about 0.1%. It's interesting, though, if you look at the dollar index, it certainly bounced off of some fairly weak levels. That continuation of an uptrend would be a very different scenario than we've seen. This is at a time when things like India, Brazil making new highs, China not quite. China's more range bound, but interesting to see. And out of all of these, gold actually the worst of the bunch, down 0.7%, when most other asset classes were positive. What outperformed stocks in this shortened week? In purple, we have small caps up 0.9%. That's the Russell 2000 ETF. In red, we have bond prices up 1.2%. So this is a week which we've not seen often, where bonds actually outperforming stocks, and that stock to bond ratio has essentially been sideways recently. Also outperforming stocks, we have emerging markets up 2%. We have crude oil, the best of the bunch, using up 4.1%. That's using the USO, by the way. And if we go back, this is going to include Bitcoin. I need to shorten this up to a 4-day return here very quickly. And if you see, Bitcoin actually was outperforming. It was actually the best up until today, and actually undercutting crude oil here for the week, still up 3.5%. But this day is what we're seeing on the charts, where things are rolling over very, very quickly. So overall, sort of mixed, right? You can see the S&P in the middle, something's underperforming, something's outperforming. But really, it was the bonds, I think, are the big surprise in terms of moving higher this week on a relative basis. And EM and crude oil, not much of a surprise there, I think, continuing their recent uptrends. We're going to finish off our Wrap the Week segment looking at the Mindful Investor Live Chartless. We look at this every Friday. If you've not seen the show on a Friday before, you can access this list if you're a StockCharts member, no problem. Go to your dashboard. You're going to see all of your chart lists. That's actually not right. Sorry. Click on the articles tab. Click on the articles tab. Go to my blog, which is called The Mindful Investor, and you will have a link at the top of that page to get to this live chart list. I update it about once a week in preparation for the show, but you're welcome to take those charts and save them, do whatever you want with them. We start with the market trend model. This we update every Friday at the close. No change from last Friday's signals, where you have the long-term model remaining bullish, and I would expect that to continue, because you would need a huge pullback to actually register a sell signal on the long-term model. The medium-term model actually turned negative 3 weeks ago, and for me, what that basically says, the market can go higher, which is what we're seeing today. What it tells me is to be thinking more about risk and less about reward, right? Think more about stocks that you're holding, positions that you have, and look at what lines in the sand you'd want to focus on. This tells you to be thinking, put your risk off hat on. And it doesn't mean to sell things just because. It tells you to focus more on where stocks are relative to support levels. And I would say with certain stocks, things like Tesla, for example, I think they've broken support and would indicate, that you need to be defensive there. But certain stocks, obviously breaking new highs, Facebook, what I would call the FAANG stocks, Facebook, Alphabet, Microsoft, eBay, all at or near new all-time highs. So those are charts that are just fine. I don't think there'd be reason to sell those based on this model. What the model tells me is to be more cautious and skeptical. The short-term model, by the way, has remained positive. It just narrowly turned negative about 3 weeks ago, but turned right back positive, and overall has remained positive since February. So what you have is the long-term secular trend is positive. That makes sense with where we're at in the cycle. The medium-term trend is negative, and what that basically does is recognize the sideways move that we've been in. If you missed my show yesterday, I had a great conversation with Craig Johnson about the 3 directions of the market. Any market can go up, it can go down, it can go sideways. We talked a little bit about that environment and what it might mean. The short-term model is positive, and again, we've reverted back higher, making new all-time highs. So that model is pretty much how I would interpret the chart. We talked about the daily chart of the S&P. I don't mean to beat it any more than that, but obviously we're making a new swing high here and breaking above, closing at a high for the week, which is all impressive. I think we're still right at the high from early May. So I don't think we've had a clear indication that things are all clear. Next week, that's absolutely what I would be looking for, right as the RSI gets above 60 for the first time since early May, when we were at this level once before. Do we have enough momentum to push the S&P on to further highs? And if so, and most importantly for me, if that would push the medium-term trend model back positive, that would signal an all clear for stocks. We haven't had it yet in my view. I tell you where things are pretty decent is with breadth picture. I'm not seeing a lot of concerns on breadth measures that I follow. The cumulative advanced decline line across the board, large cap, mid cap, small caps, all making a new all-time high in the last week. That's a constructive pattern, right? That is overall a thumbs up in the clear sort of trend characteristic or breadth characteristic. If you would see the market go higher and not being confirmed by these advanced decline lines, then it would be cause for concern. You're not seeing that. You're seeing these all making new highs, which is supportive. This week on I think this was Tuesday or Wednesday, wherever this was about 16% of the S&P, 15 to 16% of the S&P making a new 52-week high, which is pretty good. That's actually pretty healthy, and that's in line with previous bull market phases. I think what you're finding right now is you have a lot of stocks that are able to make new 52-week highs. Going to the next chart, this is how many stocks are above their 50-day moving average. And the concern I have right now is you have plenty of stocks making new highs. That's good. But if you compare where we're at right now versus where we were 6 weeks ago, we had 92% of the S&P above their 50-day moving average. Right now, it's more 71%. It might be a little higher after today's close, to be honest with you. But overall, it's in the low 70s. So that's about 20% of S&P stocks that were above their 50-day moving average in April and are no longer above their 50-day moving average. So while the S&P remained above its 50-day and kept rotating higher, a lot of stocks did not. And these are sort of the Tesla, ARK Innovation Fund types of names that are still below their 50-day moving average. So those have not participated in this upswing. This has been led more by other things like energy, which have raged higher. Today, it's follow through on some of the larger cap, mega cap tech and communication names, but it's not some of those other names. And that 20% of stocks is a bit of a concern. With the S&Ps going higher and less stocks are above their 50-day, that tells you that it's a smaller group of names that are still going higher. That is a stretch to find a negative indication for breadth, because again, it's still 71% of stocks above their 50-day. That's still bullish, right? As long as you were made above 50%, that indication, all else being equal, is bullish. We talked about sentiment yesterday, so I don't want to talk too much about it, but AAII survey finally jumping a little bit higher, up from last week, which is in the 30s, back above 40% bulls. Until we get to about 50% bulls, I think that's still relatively stable of a reading. The name exposure index has continued to increase. So that shows you in the last 2 weeks, you've gone from about 43% to about 83% of money managers or exposure to equities by money managers, which is an increase. So certainly you're seeing some buy-in. Where you absolutely have had a lot of buy-in is on the RIDEX flows. And that's actually one of the lowest readings, if not the lowest reading in the history of the series, going back for decades. That should suggest that anecdotally, the last buyer is in, right? The individual investor is fully committed to this market. We'll have to leave it here, but I just want to quickly mention, we talk about offense versus defense in consumer. This is the chart that I was alluding to. If you look at the ratio of the two on a cap-weighted basis and on an equal-weighted basis, we haven't quite broken down, but we're really, really close. That breakdown would be the first time you really had a breakdown in these ratios since March of 2020, really February of 2020, when they rolled over and really accelerated out of the market top. So this is sort of an indication within consumer that investors are stepping away from the offensive consumer discretionary into the defense of consumer staples. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.